We're seeing forecasts suggesting we're approaching what some call the line of death on the inflation-adjusted S&P 500, a level that, in past cycles like 1966 and 2000, coincided with the end of long secular bull markets. The question isn't whether prices can go higher nominally, but whether real returns from here are setting up for disappointment after an extraordinary 16-year run. History tells us that when equities run far ahead of underlying cash flow growth and real discount rates reset, the adjustment can come suddenly and quite brutally. What matters now is how that adjustment would occur. Is this a classic valuation unwind driven by a technological narrative overshooting fundamentals similar to 2000? Or is the risk more systemic, a credit or funding shock that forces deleveraging, as in 1929 or 2008? Valuation bubbles deflate over time and volatility, while credit crises compress everything at once. This chart shows the real S&P 500, adjusted for inflation, and what we're seeing is just how deeply cyclical equity markets really are. Stocks move through long stretches where investors treat them as the best wealth-building tool imaginable, but then it gets followed by equally long periods where repeated crashes and disappointing real returns push people to abandon equities at all. Historically, the US has seen a handful of true secular bull markets, from the 1920s, the post-war boom into the late 1960s, the 1982 to 2000 run, and now the post-2009 rally that's stretched to roughly 16 years. Each one eventually gives way to a secular bear. That is not because markets stop functioning, but because that enthusiasm and therefore valuation overshoot reality. Bull, bear, bull, bear. That's the rhythm. And every generation eventually rediscovers it the hard way. At Gleneus, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. We think the 1929 crash and subsequent Great Depression is still heavily misunderstood because we keep hearing the stock market collapse was the trigger that caused the Great Depression. In fact, the stock market crash itself was a consequence of a deeper banking and liquidity crisis. In the years leading up to the crash, the S&P 500 had already tripled, rising from roughly 10 to 30 points. The tragedy of this market, in our view, was that retail investors were even borrowing money to invest in stocks. When global credit tightened and banks began to fail, liquidity was the crucial missing factor. The equity market collapsed in response, not the other way around. Back then, there was the gold standard. So monetary policy prioritized defending the dollar's peg over stabilizing the financial system, allowing the contraction to spiral into the Great Depression, with US GDP falling by about 30% between 1929 and 1933, and unemployment exceeding 20%. The lesson from this era, in our view, tells us that speculative excess may amplify downturns, but it is the breakdown of credit and liquidity that turns a market decline into an economic catastrophe. The 2000 to 2001 collapse was fundamentally different from 1929 because it wasn't a banking or liquidity crisis, but a technological valuation bubble unwinding. Capital flooded into internet and telecom companies on the assumption that growth alone justified any price, even when those new firms openly admitted they might never generate profits. Massive accounting scandals at companies like Enron and WorldCom exposed how fragile those earnings narratives really were. And lastly, during the crisis in 2008, markets didn't fall because investors suddenly changed their minds, but because the entire financial system itself stopped functioning. As confidence in banks and structured credit products collapsed, liquidity vanished, just like in 1929, and asset prices were forced lower across the board. Stocks, housing market, and credit markets all fell together, not due to overvaluation like in 2001, but because forced selling and deleveraging took over. The 2008 recession, just like the 1929 recession, was preceded by a banking crisis. Both the 1929 and 2008 recessions followed the same basic mechanism. First comes an expansion of loans, usually driven by loose monetary policy. As the volume of lending grows, the number of bad loans grows with it. Once bad loans reach a critical level, a banking crisis emerges. Banks then react too late, like closing the floodgates after the dam has already broken. Lending is sharply reduced or stopped altogether. That tightening cuts off liquidity even for good borrowers, and what follows is a full-blown recession. In both 1929 and 2008, the recession was preceded by a banking crisis, not the other way around. This chart is a comparison of the S&P 100 to the S&P 500, and what it really captures is where market leadership is concentrating over time. When the ratio rises, it means the largest, most dominant stocks are outperforming the broader market. That's exactly what we saw in the late 1990s heading into 2000. when a narrow group of mega-cap tech names drove the entire index higher. And it's the same pattern we're seeing again in the current 2021-2025 bull run. The resemblance to 2001 is not about an imminent crash, but about market structure. Leadership has become increasingly concentrated, breadth has narrowed, and returns are being carried by a small group of winners rather than the market as a whole. Historically, this kind of setup aligns much more with a late-stage valuation-driven cycle than with the broad, credit-fueled expansions seen before systemic crises like 1929 or 2008. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.